Hello traders, good morning, good afternoon, good evening, bonjour, bonsoir mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders, and our website is www.stochastic-macd.com. For all trade, we use the 5% money management rules and apply stop loss in all trades. This video is for educational purposes only. The title of this video is how to trade like high frequency traders on the 1 minute chart. Let's get started. Since 2008, we have seen the number of high frequency trading firm has been increasing. All right, there are a lot of discussion about high frequency trading and how a lot of ordinary traders are complaining about the negative effect of the high frequency trading. In this video, we will share with you how one can trade like a high frequency traders on the 1 minute chart. One of the tools that the high frequency trading firms are using is the slow stochastic indicator. All right, I will discuss also first the different strategy that some high frequency trading firm are using. All right, and also I will also give you the best approach that one can adopt if one is using the slow stochastic for a high frequency trading purposes. All right, let's get started. Very often we notice that since 2008, all right, on a 10-minute chart, on a 1 minute chart, on a 2 minute chart, on a 3 minute chart, there is a lot of activity taking place. All right, this is the stochastic indicator. When the stochastic is overbought above the level of 70 or 80, all right, a lot of computers are programmed to sell. So whenever the stochastic reaches the overbought zone above the 70 level, all right, most of the program algorithm, all right, will sell. The computers will sell. On the other hand, when the stochastic reaches the oversold zone below 30, all right, most of the computers will buy. This is automatic trading methods. If one is selling each time the stochastic is overbought, and one is buying each time the stochastic is oversold, all right, it's a very, very a bad way to trade. All right, I want to show you here the best approach one can adopt if one wants to trade like a high frequency trader successfully. All right, the stochastic oscillator is oscillating between two levels, the level of 70 and a level of 30. All right, some trader will set it as 75 for the overbought zone and 25 for the oversold zone. Some trader will set the overbought zone for the 80 level and oversold zone for the 20 level. All right, in this video we will set our overbought zone at 70 and our oversold zone at 30. All right, well, we have noticed that very often, especially on a 1 minute chart, we have noticed that each time the stochastic is 833, here I'm using the stochastic 833, is overbought, most of the computer will sell. All right, and as soon as the stochastic reaches the oversold zone, these computers will take profit and will start buying again. And when the stochastic reaches the oversold zone, they will buy again. And as soon as the price reaches the overbought zone, they will take profit and they will sell again. So this method of trading is contrary to the market pattern because the market is not always consolidating. So I want to show you here one of the first market pattern, the horizontal pattern, when the market is consolidating, all right, which means the price is confined between two levels, the resistance level and the support level. One can look for opportunity, not to sell straight away, but one can look for opportunity to sell when the price returns to the overbought zone. I want to show you here. So first time we see the price goes down from here to here, and then went up here again, and then come back here. Now at this point in time, we will notice that the price is oscillating because it went down from here to this point, and then went up from here to here, and then went down again to this point. So we notice a pattern that the price is oscillating. This is only valid when the market is consolidating. So in this scenario, we can buy or we can look for opportunity to buy if, okay, the price reaches the support level. And as soon as the price rises to the resistance level, we will take profit and look for opportunity to sell. It does not mean that we'll just sell or sell straight away. We'll wait for a signal to sell when the price reaches the resistance level. And if the price goes down from the resistance level to the support level, we will take profit again. All right, you understand? So price goes up here, we take our bullish, we will take profit. And if we receive a sell signal here, we will sell again, and the price will go down to the support level. We do not just buy straight away because the price reaches support level. If you receive a buy signal here, we'll buy again. And we'll keep doing this, okay, as the price oscillating between two levels. This is only valid when the market is consolidating. What we have noticed is that sometimes the slow stochastic has been misused by a lot of computer programs, okay, in the market, a trading algorithm, all right, used by some of the high frequency trading firm. So sometimes the price not consolidating, but these these computers will be buying, okay, at the resistance level and selling. They will be selling at the resistance level and they will be buying at the support level. But what is the best way to use the stochastic, okay, like a high frequency trader? You see here I draw this line here. In fact, I will color it now into orange. Pay attention carefully, okay? I will color this line here into orange, all right? And I want to show you the best approach. So you can see here there was a high here and there was a lower high on my 1 minute chart. Can you see it? Okay, this point here and this point. I hope you can follow me. With these 2 points, because the price was display a higher high followed by a lower high. With these 2 points, we can draw a bearish trend line. All right. So if the price is below a bearish trend line, okay, so price was below this bearish trend line, and the price rises up to the bearish trend line, okay, and the common sense trend line is broken, we will look for opportunity to sell. So here it is. So you see here we have the bearish trend line and the price was below it. Now the price rises up to the bearish trend line, and what I call the common sense trend line is the first and nearest trend line, very close to the price like this. If the common sense trend line is broken, we will sell. As the price going down, we will take first profit at the first and nearest support level. If the price dip below the first and nearest support level, all right, we will continue to sell. So if we open 3 trades or 10 trades here, as soon as the common sense trend line is kaput, all right, and the price reaches the first and nearest support level, we may close 50% of the trade or 60% of the trade and let the rest of the trade run. Now, if the price continues to go down and reaches the second and nearest support level, we will take the second profit, and so on and so on. But what we have noticed that very often on the 1 minute chart, okay, I'm looking at the Dow Jones Index on the 1 minute chart, sometimes you'll notice that the price, okay, is not consolidating. So what we have seen that each time the price reaches the oversold zone, there will be an attempt to buy, aggressive buying, as soon as the stochastic is approaching the oversold zone. This is the wrong way to use the stochastic. If one wants to use the stochastic successfully, one must use the stochastic with the market patterns. There are 3 market patterns: the horizontal channel, which is the normal, okay, buy and sell, okay, as the price oscillating, and also the declining channel, which is the second market pattern. The third market pattern is the rising channel. So here we have a declining channel. Here we will, instead of buying each time, the best strategy is to avoid buying in a declining channel, all right, unless the price failed to display a new lower low. That will okay, allow us, okay, to trade, okay, to follow the market principle instead of violating, okay, the market principle. Because if we are buying anyhow, as soon as the stochastic pullback reaches the oversold zone, we are buying, we are, okay, violating the market pattern and also the market principle. So the best approach, if the price is below a bearish trend line, all right, and the price rises, as you can see here, up to the bearish trend line, and the common sense trend line is broken, and the stochastic is overbought. Here you see, this is a very good signal here, right here, this one here. We will look for opportunity to sell. This, when the stochastic was overbought here, this was not a sell signal, but this one here is a better signal because the price was below the bearish trend line, and the price rises up to the bearish trend line, all right, and the common sense trend line is also broken. This is a better signal here. You can see that stochastic pulled back to the oversold zone. A lot of program has been set to buy each time the stochastic reaches the oversold zone. I can understand one can take profit because if you sell here, the price reaches the first and nearest support level. It's okay to take profit. If one is taking profit after a bearish trend, one is buying, all right? But to take a bullish signal just because the stochastic is oversold is completely wrong, and it's a violation of a market principle. All right. So here you can see that the stochastic reaches the oversold zone. Some competitors will try to buy, but this is not the best way to use the stochastic. Here again, we can see that the price rises again all the way to the trend line right here. We'll wait for the common sense trend line to be kaput right here. You can see that the trend line was broken a little bit here. At this point in time, we were here. Right here, all right, right here, okay. But as you can see, the price went down a little bit and continued to go up again. If the price goes above, okay, the trend line, we will close the trade because the price is not going down anymore. The price is not displaying a new lower low. That trade is a losing trade, but it's not, okay, a bad signal because the price rises up to the common to the bearish trend line. The common central line is broken. The price start going down a little bit, but went up again, all right? But if we draw, or if you adjust our line, our common central line like this, here, this was a better signal. The price went above the bearish trend line and quickly returned back below it. This is a sell signal. Here we have a better signal right here. As you can see, very often what we have noticed is that sometimes the computer will sell here because the stochastic reaches the oversold zone. The computer will sell again here because the price, the stochastic is in overbought zone. And also this computer will sell again here. This is a distortion. This is, I'm not saying that this is a kind of market manipulation, but this is the wrong way, okay, to use the stochastic. Sometimes it can be very, very scary. Sometimes you will see that on a 1 minute chart, especially when New York is open, all right, or London is open straight away. Most of the computer will quickly sell as soon as the stochastic reaches the overbought zone on the 1 minute chart, and will buy each time the stochastic is oversold, and will sell again as soon as the stochastic okay, reaches the overbought zone. This is like forcing the market, all right? It's forcing the market altogether, all right? And it's the wrong way to use the stochastic. Here again, you can see here that the stochastic, the price again, because we are below the bearish trend line, the price rises again to the trend line here. But this time, the common central line is not kaput, and also the price is above the bearish trend line. We cannot sell, okay? We cannot sell here, all right? You can see that the price rises up to the common central line, to the bearish trend line, but the common central line was intact. The price did not violate the common central line. We cannot sell. But what we have noticed, a lot of computers will just sell and they will force it. And this is creating a lot of distortion on the market, especially if okay, the market participant is okay, a big market player, all right, or an influential market player, all right. All right, so you see here, the stochastic was overbought. This is not a sell signal, all right, because the price is still above, okay, the common sense trend line. The best approach is to allow the price to go back below, at least below the bearish trend line, before one will look for opportunity to sell. This is the best approach to use the stochastic successfully. All right. I want to show you another financial instrument, and this time I will use the Euro USD currency pair. Since 2008, because the market was bearish, in 2008 to 2009, all right. The S&P 500, the stock market was bearish. A lot of hedge fund, some hedge fund, went out of business, and also a lot of big market players were caught by the bearish season, and they lost a lot of money because they were buying and holds. All right. In the past, most big market players like the bank, the hedge funds, they do not trade on a lower time frame. They do not spend too much of their time on the lower time. Though they are trading sometime on the lower time frame, they were busy trading on a higher time frame using a multiple time frame trading method. But since 2008, we have noticed that most big market players are now spending most of their time on the lower time frame using the high frequency trading method. And one of the trading indicators that they are using is the stochastic. Now you have to understand that sometimes these software or algorithm are developed by the computer engineers. So if the high frequency trading firm is providing a wrong trading system to these computer engineer, they will create exactly what they ask for. All right, but we should build a trading system that is in harmony with the market principle. But if we create a crazy trading system, that will end up creating too much distortion in the market. And one of the craziest trading system is to sell each time the stochastic is overbought and to buy each time the stochastic oversold. That's the worst trading system you can come across. All right. So as you can see here, that's the best approach. So now, though the stochastic was overbought here, this is not a sell signal, and no computer should be programmed to sell in this condition. By selling here, one is forcing the market, or one is distorting the market, or one is trying to manipulate the market. Now you have to understand that how should I put this to you? These market participants, I'm not saying that they are manipulating the market, but they can unconsciously or unknowingly or unwillingly distort the market if they create a wrong trading system, or a trading system that is not viable. All right. So if you are a powerful market player and you are selling each time the stochastic overbought, oversold anyhow, you are distorting the market. Let's bring on now another financial instrument. All right. And this time we'll look at the Euro USD currency pair, and we want to demonstrate the best approach one can use if one wants to trade like a high frequency trading. Here again, as always, when we are building a trading system, we must always incorporate the price. What we have noticed that most traders or most market participants like the indicators, and they will spend most of their time, or they will create their algorithm based on the indicator alone, and they will completely ignore the price. That's the worst trading system you can come across. So here we are. So you can see I draw some trend line here. The first one that I draw here is a bearish trend line. This point and this point, this point and this point. On the 1 minute chart, you can see it's a bearish trend line. So 2 points. We just need the price to display a high followed by a lower high. As soon as we see a high followed by a lower high, we can join these 2 points to draw a bearish trend line. That's it. If the price is below the bearish trend line, ladies and gentlemen, this strategy is valid. One can apply it on an hourly chart, on any time frame, but for high frequency trading purposes, we are on a 1 minute chart. So the price below a bearish trend line, now we have this point, these 2 points, all right. If the price goes down and display a lower low and rises or rally up to the bearish trend line, and the common sense trend line is kaput or is broken, Stochastics is also overbought. We will look for opportunity to sell. I am not saying that we will sell. We will look for opportunity to sell. All right? All right? Now, though we are stopping on one single time frame, which is also a violation of the market principle. If one is trading on a single time frame, all right, which means you are not using a multiple time frame trading method, as you can see here, I did not use another time frame at all. I'm just stuck on the 1 minute chart. If you want to trade alone on one single time frame, it's a violation of a market principle. To avoid distorting the market, one must, okay, adhere to the market pattern at least. This is what we are doing here. All right, so at least we should, okay, respect, okay, or align our strategy with the market pattern. Rising channel, declining channel, horizontal channel. So when the price is in the declining channel, we will not buy it, okay, unless the price fails to display a new lower low. All right. On the other hand, if the price is in a rising channel, we will not give priority. We will not sell at all, or we will not look for opportunity to sell, okay, unless the price failed to display a new low, a new higher high, or the price display, okay, a lower high. All right. So here we are. Now here it's difficult to show you because here, as soon as the price started going down, it went down a little bit before pulling to touch it here. Are you with me here, right here? All right. It's not a very clear signal. All right. But as you can see, the price continued to go down. All right. But if you go to this one with the price in a rising channel, I can use this point and this point. This point and this point allow me to draw my bullish trend line. So the price above a bullish trend line, I'm going to move this one away. Above a bullish trend line, all right. If the price pull back near, okay, the price, okay, pull back near the bullish trend line, and the common central line, this common central line is broken, we will look for opportunity to buy if the stochastic is also oversold right here. All right, this one here. The stochastic is oversold, all right. The price above a rising trend line and pull back near the rising trend line, the common central line is broken, and the stochastic is also oversold. Sometimes the stochastic may not be oversold, but if the price pull back near the common the rising trend line and the common central line is broken, we can buy, even if the stochastic is overbought. All right, because the price is the #1 indicator. All right. But here, the stochastic was also oversold. So to create a viable algorithm or a viable trading rules that one can implement with the computers, one must respect build a strategy that is aligned with the market pattern price. So the first condition for our trading rule or our algorithm will be the price above a rising trend line. Second condition, okay, the price pull back near the rising trend line. Third condition, the common central line is broken, which means the price went back above the common central line. Okay, fourth condition, okay, which is not necessary, but because if you want to use the stochastic, we will say, and the stochastic is oversold, we will buy. Price going up, a fifth rule, we will take first profit at the first and nearer resistance level. If the price did not display double top at the first and nearest resistance level, and the price goes above the first and nearest resistance level, we will let the rest of the trade run until we reach, until we reach the second and nearest resistance level. If the price reaches the second nearest resistance level, we will take profit and then wait until the price goes above the second nearest resistance level. And we will let the rest of the trade run, and so on, provided that we open maybe 10 trades at the beginning, and we may close them steadily as the price is moving up from one support level to the next resistance level. If the price reaches a resistance level, we'll take profit. And if the price validates that first resistance level as a support level, which means it goes above it and finds support, we will continue to buy until the price reaches the next resistance level. We will do the opposite when the price is in a declining channel. So if the price in the declining channel as it is here, and the price rally up to the bearish trend line. So I'm going to move this one away up to the price below. So the first condition for a bearish trend, the price for your algorithm, all right? The reason why I'm doing this video, because sometimes I see it and I know that there are some computers that are messing, okay, the market, that they are distorting the market, okay, consistently. And this is not, okay, the right way, okay, to use the stochastic. So the first condition for a bearish trend will be price below, okay, negative slope trend line, all right? Second condition, a price rally, okay, up to the negative slope trend line. Third condition, the price now, the price deep below the common sense trend line start going down, okay, and also the stochastic is overbought. We will sell, price going down, we take first profit at the first and nearest support level. If the price goes below the first and nearest support level, we will continue to sell or let the rest of the trade run until we reach again, okay, we reach the second, okay, nearest support level, and so on and so on. All right? All right? So now we see here the Euro USD is in a rising channel. Now it's here. What we will do is pulling back near this one, as you can see here, the common centralized caput, all right? Can you see my common central line? Color it now again into orange, okay? It's kaput, can you see on your chart? Okay, so the price is in the rising channel, you pull back near the rising, okay? The rising trend line, all right? The common central line is broken, so the price in the rising, above the rising trend line, first condition, verified. Second condition, the price now break above the common central line right here. Second condition, okay, is now the second condition. So let's start again. The first condition is that the price is above, okay, a rising trend line, which is this one here. So I'll move this one away. So the price is above, okay, a rising trend line, okay. Second condition, the price pull back near the rising trend line. Second condition verified. Third condition, the price break above the common central line right here. Great. Third condition, the stochastic, okay, third condition, which is not very important, but if you want to use the stochastic, we will say that the stochastic is also in overbought zone, or the stochastic is bullish. Sometimes the stochastic will not reach the oversold zone, but you can perfectly buy, all right? And here, this is a bullish trade. So as the price we buy here, as soon as it goes above it here, the price going up, we will take first profits, well, at the first and nearest resistance level. So this is our first and nearest resistance level, we take profit. Now you can see that the price stuck below that first and nearest resistance level. The best thing to do is to take all profit and wait for it. So this is my warning line now. So if I want to buy again using my algorithm, or if I want to set the rules, is to tell the computer to sell if the price fail to sell all, okay, to take all profit, all right? So we buy here, so as we reach this level and the price stuck below the first and nearest resistance level, we may close all trade, take all profits, all right? So if you open 10 trade here, instead of closing half of the trade, we may take all profit straight away, all right? And wait for the price until it goes above it. Here you can see, in this scenario, we will not buy now. Though the stochastic was bullish here, we will not buy because the price is below, okay, the first resistance level. So we will wait. If you are bullish, if you are crazy bull or permanent bull, and we like to buy all the time, at least to avoid distorting the market, we'll wait until the price goes above, okay, the first, okay, resistance level. All right? Normally, I should charge high-frequency traders for recording this video, but it's free for them so that they may stop, okay, distorting the market. Why are we recording this video? There is, okay, a huge panic among the ordinary traders, and the high-frequency trading firms are becoming very unpopular, and a lot of ordinary traders dislike these market participants. But there is nothing one can do about it because These are market participants. If they are crazy traders, they can trade like crazy traders. It's their right to trade like crazy traders. If they are aggressive traders, this is their trading style. But the danger is that if these market participants, okay, are big market players, they can distort the market, and that can create, a lot of problem later on. A distorted market is not good for anyone at all. All right, that can create some sharp correction. Okay, talking about the distortion of the time and the distortion of the price itself. All right, which we will talk about in another video. So we are doing our best here, okay, to demonstrate to traders the best approach if they want to use the stochastic successfully without violating the market price. So here we will not buy. Again, even here is coming there. So at least here, now you can see that it's below the first resistance level. So here we are, let it run. So now it's coming back, it's pulling back again to retest the rising trend line, okay? This is our rising trend line. Let's color it into red, and let's do this live so you can see the demonstration here on a live chart. So now it didn't go above it, so we'll take profit, close our trade, as computers set your rules to close our trade. So now it's pulling back near this is our, market pattern, the rising channel. So it's pulling back near, so move my green line here, so it's touching here. So what do we do? Okay, the computer will wait according to the rules for the common central line here, kind of, okay, if you accept that, common central line like this, if you allow that, okay, to be kaput. But because we are very close to the first and near resistance level, how much profit you have to always consider the risk-reward ratio. So now it's above the common central line. Let's remove this one. So, but it's very close to the resistance level. Sometimes I see traders doing that. They want to buy because they receive a buy signal. Sometimes traders buy a trading system. They receive a buy signal and they take it. They say, this is the signal and I'm taking it. But you don't have to take every signal because you are the decision maker. If the signal is in the wrong place, you don't take, you see now. So I will not take this one because it's very close to the first and near resistance level. All right? All right, it's very close. So if you want to sell, it's better to sell because now, I mean, normally I won't sell now because the price is still above the rising, trend line. All right. Okay. So if you want to buy, we will prefer it to go above the first and near resistance level, okay, and to find a support, at least to close above it, okay, and then we continue to buy again until it reaches again, the second nearest resistance level. But this is the best approach one can use, okay, to trade like a high frequency trader, the best high frequency trader, because I know there are some crazy high frequency traders, they are not in the proper sense of the word, but they are using a wrong trading system. The program, the algorithm that they are using is violating consistently the market patterns. So you can manipulate the market on a lower time frame easily if you are a major market player. That will be the subject of another video, all right? But we are recommending to these market players because to have an orderly market, one should not consciously or knowingly violate, the market principle. So, to summarize this video, to sell successfully with the stochastic, trading like a high frequency trading firm, all right? The price, the first condition, the price should be below a declining trend line or in a declining channel, all right? Below a declining trend line, first condition. Second condition, price, rallies up to the declining trend line. That's the second condition. The third condition, the common central line is broken, so we price deep below the common central line, and the stochastic is overbought. The stochastic overbought is not, how should I put it, is not a very important condition, but if one wants to use the stochastic, one may say that the stochastic is also overbought. And then we will sell. If the price going up, the following rule, we will take the first profit at the first and nearest resistance level, because the price is going from one level to the next level. This is also, okay, a market principle. Price moving from A to B all the time. So when you are trading, you enter a bullish trade, you must know your target level. Always, you must know. Next target level. It's moving from A to B. Price reaches the first and nearest resistance level. Okay, if we are, according to our risk tolerance, we may decide to close all trades. So if all trade, we open 10 trades, and they are all profitable, we can close them all. And then wait. But as we are closing a bullish trade, you see that the price may pull back a bit, which means that we want to close a bullish trade, we must sell. So, as a big market player, that can also disturb the market because they don't sell in one go, they sell gradually, all right? They close trade gradually, so they may decide to close, okay, 50% of the trade or 30% of the trade, and then we'll let you see what's going on, all right? And if the price goes above the first, okay, nearest resistance level, we buy again. And the price reaches the second nearest resistance level, okay, we take profit again and wait for it to go above, okay, the second nearest resistance level before we buy again for the third time. If you want to, okay, so for selling, we are going from one resistance level to a support level. So if the stochastic is overbought, the common central line is broken, we sell, we'll take first profit as soon as the price reaches the first and nearest support level. We can close all trade. If the price goes below that the first and nearest support level, we continue to sell, price reaches the second nearest support level, we take profit again, we wait, price dip below the second nearest support level, we sell again, and so on. If you want to buy, the first condition is that the price should be above a rising, okay, trend line, as we see here, a rising trend line. And the second condition is that the price must pull back near the rising trend line. So the price above a rising trend line and price pull back near the rising trend line, second condition. Third condition, the common central line is kaput, good, and the stochastic is bullish or oversold. Sometimes traders get into trouble. They are trading the stochastic sometimes, and they get into trouble. Sometimes the stochastic will be overbought, but the price will pull back like this, and the trend line will be broken. We can buy. We are trading the price. We are not trading the stochastic. As always, one tips for traders, you can set another rule to draw a warning line, all right? So when we buy, we can decide to say 2 pips below our buying point, okay? Can be our warning line. So if the price dip below that level, we can close all trade. All right? As the price going up, reaches the first resistance level, we close all trade, or we close 50% of the trade. If the price goes above it, we continue to hold those positions until we reach the second nearest resistance level. We take second profit, all right? Or we close all trade, it's up to you. And if the price goes above the second nearest resistance level, we buy again if the price finds support. We can also use another, okay, warning line, okay, to manage the trade. This is about how to trade, okay, like high frequency traders on a 1 minute chart. All right. I hope you have learned something from this video, okay, and we put it to use to make excellent decisions when one is using, okay, the slow stochastic indicator. Until the next time, enjoy yourself and be very happy. We are the TSTW 24 traders. Speak to you soon.